Before starting the video, click the subscribe button and turn on the notification bell. Welcome to House of Commerce. Hope you all are doing well. So today we are going to discuss about revenue recognition, how different type of businesses record their revenue in their books. So watch the whole video and you'll get the complete knowledge about the revenue recognition of different businesses. So let's take a look. Definition of revenue says the gross inflow of economic benefits arising from the ordinary activities of an entity that result in increase in equity other than contribution from equity holders. So this is the thing that you must know, that what does this ordinary activities means. This means that it is in the ordinary course of the business, it is the regular course of business of the entity, and activities of entity that result in increase in equity other than contribution from the equity holder means that owners does not have to contribute anything. It is the external inflow of cash from any other source other than equity. Then we got to know what is fair value in revenue recognition. Fair value means the amount for which an asset could be exchanged or a liability settled between knowledgeable willing parties in their arm's length transaction. So fair value means if the asset is exchanged in the market, so the market value of the asset which is being influenced into the market, and the amount for which the liability is to be settled is the fair value of the liability. So this is the fair value means here. Then coming to the measurement of a revenue. Number 1 point says revenue is measured as the fair value of the consideration received or receivable, taking into account any trade discount or volume rebates allowed. So if the cash is received or to be received in the future, then the revenue will be recognized having deducted all the trade discounts and the rebates allowed. Then number 2, if the inflow of the cash or cash equivalent is deferred and the arrangement effectively constitutes a financial transaction, the fair value of the consideration is determined by discounting all the future receipts using an imputed rate of interest. The difference between the fair value and the nominal amount is recognized as interest revenue in accordance with IAS 39. This means that if the cash or cash equivalent is more than the actual amount, the nominal amount of the asset, means if you're purchasing anything on an installment basis, so its value is more than the actual amount of the asset. Therefore, the difference between the fair value and the actual amount, the nominal amount of the asset, is an interest revenue and shall be recognized in the books of an entity. Then number 3, amount received on behalf of other parties. Sales tax, value-added taxes, amount collected on behalf of the principal in agency arrangements are not economic benefits flowing to the entity and do not result in increase in equity. So these are not revenue. If the sales tax is collected on behalf of government authorities or the amount is collected by the agent on behalf of principal, so that is not the revenue for them. Now let's take a look on the entity if it is involved in sale of goods. So how shall it record its revenue? Revenue from the sale of goods is recognized when all the following conditions have been satisfied. So let's take a look on each and every condition separately. The entity has transferred to the buyer the significant risks and rewards of ownership of the goods, means each and everything related to the asset ownership and each and everything has to be transferred to the buyer from the seller, and nothing has to be left over to the seller. then the entity retains neither continuing managerial involvement nor effective control over the goods sold. Means the entity now does not have anything to do with that asset. Now it is in the ownership and it belongs to the buyer, and seller has nothing to do with that. Then the amount of revenue can be measured reliably, that how much has to be inflow to the company. It must be recognized reliably that you know the amount of how much is to be collected from the customer. It is probable that economic benefit associated with the transaction will flow to the entity. That it is reliable or it is probable means there are more than 50% chances that revenue will come to the company and the cash will be paid by the buyer and he will not default in paying the cash. Then the last one, the cost incurred or to be incurred in respect of the transaction can be measured reliably. So the cost upon which was made upon purchasing the asset or manufacturing the asset should be measured reliably so that you can calculate the profit on sale of the same asset. So this is all in the case of sale of goods. Now if the entity is involved in rendering the services, so how will it record its revenue? Now let's take a look. Revenue for the rendering of services is recognized by reference to the stage of completion of the transaction at the end of the reporting period. If the outcome of the transaction can be reliably measured. So, if the outcome can be reliably measured, for example, $100,000, and at the end of 1 year, the work is completed only 25%. So you will recognize 25% of 100,000 in your books, and the remaining shall be recognized when the services will be provided. Then now let's take a look on the conditions. This is the case when all the following conditions are satisfied. The amount of the revenue can be measured reliably. If it is measured reliably so that you can calculate the cost of completion or the revenue recognized at the period end. It is probable that the economic benefits associated with the transaction will flow to the entity, that there are more than 50% chances that the customer shall pay the money to the seller, to the entity, so that the company will recognize, or else it will go into the bad debts. Then the stage of completion of the transaction at the end of the reporting period can be measured reliably, that it must be known by the company that how much work has been done till the end of the accounting period, so that it can measure the revenue reliably. The cost incurred for the transaction of the goods to complete the transaction can be measured reliably, so that you can take out the profit from that transaction. If you know your cost incurred upon the services, if it is measured reliably, so then you can calculate your profit by deducting the cost from sales or from this income from services. And then the last one is, if the outcome of such a transaction cannot be measured reliably, revenue is recognized only to the extent that expenses recognized are recoverable. So if the revenue cannot be measured reliably, so the entity will only recognize the expenses are incurred till then on the transaction. So it shall recognize only those the amount to the extent of that expenses and not more than that. So let's take a look if the entity is involved in the income like interest, royalty, or dividend-based incomes. So how would it recognize its revenue? When the receipts of the economic benefits is probable, means when there are more than 50% chances that revenue will be inflow to the entity, and the amount of the revenue can be measured reliably, that how much income you have to earn from interest, royalty, or dividends. Then revenue should be recognized as follows. Interest should be recognized using the effective interest method per IAS 39, and IAS 39 says that the interest should be measured between the difference between the fair value and the nominal amount or the actual amount of the asset. Then royalty should be recognized on an accrual basis in accordance with the substance of the relevant agreement. So royalty, if anybody does not know about royalty, so royalty means if you're using any name of any author or someone, so you have to pay the royalty of using that patent or that name which you're using. So if the person is involved in such kind of business, so he has to record the revenue which is agreed before starting the contract and which is written in the terms of contract. Then dividend. Dividends should be recognized when the shareholders' right to receive payment is established. Means when the company announces the dividend in its meeting, so it is the obligation to pay to the shareholders. So the shareholder shall only recognize the dividend income when it is announced by the company and not before it. So this was all for today's lecture. Now that's all for today's lecture. If you have any question regarding today's lecture, you can put your question into the comment section and that shall be answered into the next videos. Till then, good luck.